Hello, everyone, and welcome to Quick Start Lab number 2. It's a wonderful morning. We woke up to a beautiful day, snow on the ground, probably won't last long, but we're just so grateful for all of the students that are learning so well. You guys are doing a phenomenal job. We had a great session 2 nights ago. I absolutely expect we'll have a great session here today as well. So this should be great stuff. Someone says, Andy, I hope you're feeling better today. I'm working on it. If I talk about coughing, I'll cough. So I'm joined by Corey Halliday. Corey, how are you this fine day?
I'm doing great. Excited to be here.
Let's do our disclaimer quickly. We never gloss over it. We always hit it. 3 things to take from this. We're about education, not advice. We don't give stock picks, and that's difficult for us because it makes sense to use illustrations and examples that are real to educate, and it's very difficult because we will make sure people do this in a paper trade account when they're starting out. I had a friend of mine who was not in our, not part of our group, and he was talking to me about some of these things, and I told him some of the things I was doing. Next thing you know, he had 70 grand for his first day. He's got $1 million account, but still 70,000 of it, it's 7% of his money out there. And I'm like, hey, cowboy, settle down there, buckaroo. So it's very important that you understand to do this in a paper trade account, learn it. There's plenty of opportunity. It's not going anywhere. Really learn it. The second thing is we don't make any warranties. We're going to make money in trades. We're going to lose money in trades. And we had a great question that we're going to start with, like where do you decide, where to put your strike, and that's going to be up to the individual. So we'll cover that. But the biggest thing about this is just always respect the risk. The moment you don't respect it, that's when it gets you, and that's true in space. The moment you don't, in astronauts, you got to respect that risk. That's when it gets you. It's true out on the seas. It's true when you're using a firearm. Anytime you don't respect that risk, that is when it's going to get you. So with that, let's move over here. And this is a risk graph. Both Corey and I put this trade in. He got filled a little better than I did. We were going for 21, and we wound up getting filled a little bit better than we thought.
Yeah, 21 cent credit, but you'll notice that GLD gapped down yesterday morning. What that means is that it started the day priced at a lower price. And if the stock starts lower, then the put options go up. Remember, back in option basics is stocks going down cause put options to go up in value, just the same way that stocks going up cause call options to go up in value, right? Calls go up when stocks go up, puts go up when stocks go down. So we're selling a put spread, meaning we get more money, we get more premium. I think Andy got 38 cents, I got 40 cents, but basically the same thing. We'll use the 38 here for our example purposes, but 38 cent credit is better than a 21 cent credit. Would you rather collect $21 or $38? $38's even better. So that gap down actually helped us to get a better price fill.
So one of the questions that was asked that I thought was a great question.
Andy, you might be on mute there. Sorry, bud.
Thanks. I've been coughing, and so I mute when you're speaking so I can sneak in a little cough, like mute, and I'm back like that.
Yeah.
Let's take a look at this. This is called a price slice in this software. You see I can move this around, and this price slice does a lot of cool things. I'm going to set it right here at our strike at 130. Looks like we got it at 136 here. I'm going to get that as close as I can to 136. And it tells me a lot of things that we'll learn about eventually in the Ultimate Options class down here. I'm big into teaching theta and delta, theta, and vega are very important to understand. But another thing this price slice does is it looks at standard deviation. So this gray area, can everyone see the gray area? Don't put too much stock in this because it can always move outside of it. Don't make it a boundary that you don't make it more what it is. But basically, this gray area, they look at the behavior of how this has gone, and they say, well, how volatile is it? We can throw an average true range on there for similar types of ideas. It just says, a standard deviation means that if this thing acts the way it's been acting, this is how far it would deviate from where it is right now. So does everybody kind of catch that idea? That's a fancy word, standard deviation, but standard means, well, what's regular, right? What's my standard operating procedure? What is the basketball standard? Really is 10 feet high, right? Oh, that's the standard. And so standard is just basically what's normal. And so based on its movement recently, we wouldn't be surprised for it to move inside of here. Now, once we get outside of this gray area, now we'd go into a second standard deviation. So you can see that there's some percentages here. And right now, there's an 88% chance, based on standard deviation, that we're just going to keep this money. There's 11% chance that we're going to buy the gold. Now, I'll tell you what I like about this, Corey, is, what if we end up, we're going to buy this at 136. We've made that promise. It's 136, right. We're buying it. So what if it goes down to like 126? Well, we were okay with that, remember, because we chose our own price. But watch this. The chances of this getting to 130, for us, buying it at 135 and going to 130, it's only 4%. The chance of it going to 125, about 1%. Now, don't put too much stock in those things, because a tragedy can always happen. But right now, we feel that gold's probably more bullish because of the Fed. If too many people buy gold, there could be short covering to drive it back down. There's all kinds of things, so you never really know. And like I said, it's always uncertain, but we use these as an idea. Now, could we have done something where we really wanted to buy the gold? If we really wanted to buy the gold, we could have bought one, very, very close. I wanted some more Kraft Heinz today. So this morning, what I did, I'll just put this in quick. This morning, I decided I want to buy another 1,000 shares of Kraft Heinz. I really like where that stock is. Let's get rid of all these from the Mentor Club, because that's not my personal account. We got all kinds of stuff going on at KHC. But you'll notice that if you look at Kraft Heinz, it's sitting here, KHC. It's sitting here around $20, $24. I just love that this in the last 2 weeks has just not had the volatility that the market has. It's a food company. It pays a ridiculous dividend. And you can see right now it's around 24. Well, watch. If I decided to buy this and I said, I want to do this 17th of April, let's say, look how fat these premiums are. If it's at 24 and I'm willing to buy if it's 24.37, I'm willing to buy that right there. Look at that premium, Corey, that I can get. I can get probably $1.30 for this right now. And so I can get a lot more premium, but notice how close to the strike price I am. In our GLD trade, we wanted to be conservative because, we know you guys are just starting out, and we don't want anyone to not follow our advice, a paper trade account. We know that hopefully there's no dishonest people that are trying to do this live, but if we were to bring this clear up here, we'd get a lot more money, but we'd have more risk in buying the stock higher. So anything you want to say about that, Corey?
Yeah, that's exactly right. So think of it in terms of a teeter-totter. When you have a higher probability trade, you bring in less income. Yeah. If you want to bring in more income, the teeter-totter swings that way, you have a lower probability of it just finishing without you having to do something. So to use an insurance analogy, if let's say a car, you have this car that you're insuring. The insurance company could go about insuring it in a couple of different ways. They could say, well, do you want full coverage or do you only want, catastrophic insurance or something like that? Meaning that the first few $1,000s of damage are on you, but as the insurance company, we'll pick up the extreme damage. If it's totaled, we're on the hook. But if it's just a fender bender, you got to cover that. That's probability. Probability is you're going to get into a fender bender, but you're probably not going to total the car. So, that's that analogy of insurance. So they don't collect as much, right? They don't collect as much premium because the probability of it being totaled is low. However, if it's totaled, right, now they have to step in. So that's a lower probability scenario. They didn't collect as much premium, but they're still on the hook for that. That's how you can think about these strike prices. If you're selling a put option that's at a strike price close to the price of the stock, what he gave as an example, KHC's at 24.
Let's just do one.
Yeah. So if you look at, well, here's GLD. So GLD's at 153. Okay. Let's go to a strike price that they call at the money. At the money is the 153 strike because the stock's at 153. You're collecting $5 if you sell that put option.
Wrong one. Sorry. And we want to shave the spread. I'll probably go. What would you go about $5 here or $5.05
or $5.05? You're right in that neighborhood. So that's $5 per in premium is about $500, right? That's what we're collecting. So here you can see on our risk graph, see the line that green. Do you call that green? I call that green, but I'm not sure.
I don't know. It's yellow, goldish, right? It's here.
Oh, you're seeing it. Oh, yeah, but I was talking about the risk graph line. I don't know if that's blue.
Are you colorblind? Okay. Blue? I have two friends that are colorblind. Yeah, aqua, and then we have this mauve.
we will see colors, and my wife and I will see it differently. Like I call that kind of a green color. And I wasn't sure if people see it as blue, but anyway, that bluish green.
My wife uses fruit. Okay, she uses fruit all the time to describe. So you'll notice here that look down here in this circle, and just watch the blue one here. Notice here that if the stock goes up, we make $500. That's a lot different than what we have here, where we have $38. So we have $38 here in our spread, but in this one we've got $460 if we do it now. God, we are getting earthquakes all the time. I can't believe this. Aftershocks.
Did you just feel one?
Yes. Golly, I'm about getting under the table.
So you see the $500 right there at the peak.
460.
See how it's flat?
Yeah.
You see how it's flat at 500 on that turquoise color. That means that's kind of your max gain all the way there. But notice down at the bottom the 153 share price. So that 153 share price, it has kind of this dotted gray line that goes up there. What it's showing you is that if you sell that put, you're bringing in $500 and that's your max gain. You're going to make that if the stock goes any of those prices to the right. So see the numbers down on the bottom. If it's at 154 at expiration, 158, 160s, all of those prices, you make the $500, right?
Yeah, look in the box that's circled. The one you want to look at is the expiration, the blue line. See, I'm maxed at 505. So anything above 153, I'm making 505. But I have a 50% chance of owning the stock here and a 48% chance that it goes up and I don't. So when you do a spread like this, let's go back to what Corey said and let's really make this simple. Look, you want to look at three things. You want to look at the reward. And the reward has to be there to attract you. As I do my personal fundamentals, okay, and I ask myself about income, expense, asset, liability. You remember that 2 nights ago, I said I might buy gold bullion, physical gold, because it might act as a teeter-totter against currency and hedge currency. Or I might just want cash flow off selling options, and that's what we're doing right here. So I look at what my reward is. The next thing I've got to do is I've got to see how much risk I'm taking and then position ties to risk, not reward. So the reward tells me, it attracts me. I mean, I'm not going to do anything if the reward isn't there. But after I see what the reward is available, now I evaluate the risk. I say, well, is it worth it? And is that risk too big for me? This is the most important one. And then the third thing we have is what we call probability. Okay, now I'm going to play some fun games with you. I don't know how to spell probable. Probable. There we go. Probable. So I'm going to play a game with you guys. We're going to get interactive like we did last night or the other night, and this should be fun. Okay, I'm going to talk about the risk of something that's pretty much every day first. Let's say you look in the refrigerator today and you're out of milk, and you decide, you know what, let's go to the grocery store, let's drive down there and get a gallon of milk. Okay, ready? On your mark, set, type this in the question box. Let's take a poll. High risk venture or low risk venture? On your mark, get set, go. High risk venture, low risk venture. Now I see some of my students have been through my risk management class, so this is pretty good. All right, so we got a lot of people saying low, and we've got a couple people saying high. Okay, well, let me ask this. Is it possible that on your way to the grocery store that someone who's inebriated could broadside you and unfortunately take your life? Is that a possible scenario? Has it happened before? Oh, so we got a lot of yeses here. So the risk that we are taking when we go to the grocery store to get a gallon of milk is death. And that is the risk of going to the grocery store. Now, to me, that's a very high risk. That is a huge loss. And the reward I get for risking my life on the highway is I get milk, maybe 1 gallon of milk. So I might ask you, if I'd have set up this question up before, I said, are you willing to risk your life for a gallon of milk? Well, John Paul says, I don't drink milk, man. Well, okay, let's say it's a beer. I don't drink beer, I drink milk, so maybe it's that. So I really like what Robin North has to say right here, and that Antonio gets this. Antonio Delmonico, some of you guys saying, yeah, but Andy, the probability of success, right? The probability of, let's just say, probability of death, the probability of death is so low that we say, you know what, we're willing to take that risk. And that's where insurance companies and actuaries really earn their money is, you know, there's always risks that are a lot more than we think about. Usually when you get in the car, you might briefly think about an accident as you snap your seatbelt in, but after that, you're listening to the radio, you're thinking about other stuff, we really don't think about this much, because the probability is there. You know, we can lose quite a bit of money in this trade, actually. If we go back to the trade that we're actually in, we're actually in, you know, and we move this, back down here where we're at. Okay, here's where the stock is today at 153, right all the way up here. It's gone up to an 89% chance of just taking that cash. 10% chance will own the stock, and like a 5% chance will lose some money, and there is a 4% chance we could lose all of this money. And you think about it, is $38 worth risking $462? Well, it depends on the probability. So if the $38 represents the milk and the $462 is the worst case scenario, which represents death, we have to decide if $38 is worth risking $462 at the outset, and what the probabilities are. How many are starting to understand this risk, reward, and probability discussion, and who likes it? It's good. Tim Thorpe says, I'm all in for the beer. I'm all in for the beer. So this is awesome, right? This is really good stuff. So what we're going to do on this one is we're going to stick with this same trade. Okay, we're not going to introduce a new trade possibly. We might talk a little bit about shorting, but what we want to really think about is how we might hedge this, because here's your problem. And it's so tough in the quick start labs because you got to do so many concepts quick, but that's what you guys signed up for. When you have an option, and Corey can talk a little bit about this, when you have an option, let's draw a black graph like this. You have the premium you paid, and maybe you paid, $1 for this or whatever. And maybe this dollar gives you, well, let's say it's like $3. That'd be more realistic. Maybe that comes here, and here is where it expires. So we have 3 months, 2 months, 1 month expiration. It's not a linear relationship. This is going to come like this. Well, let's put this in black as well. It's going to go something like this. It's parabolic. And so watch this. The amount of time, because premiums are made up of time. Think about your insurance policy. What do you measure your insurance policy in? Oh, I got a 6-month policy. How do you measure your rent? Oh, we rent month to month. No, I got a 3-year lease. There's always time. LeBron James has a 4-year contract, right? There's always an element of time here. So if you go $3, $2, $1, 0, okay, what we're going to do here, watch this, is we're going to say, well, let's see what happens at the end of month 1. That's the amount of time decay you'd experience in month 1. So barely at all, right? From $3 to 2, you still got a long way to go, right? In that first month of time decay, okay? Now watch this. With this month, okay, now we're starting to get a little bit of time decay in here. Whoop, I should have done it better than that. Hang on. Let's see if I can. I got to put it on the line. There we go. That's a little better. After 2 months, we've got a lot more time decay. You see this? And at the last month, we've got a tremendous amount of time decay. So if you were going to buy milk, think about this. If you were going to buy, we finally get that grocery store and we're going to buy the milk, would you want to buy the milk with an expiration date? I mean, well, I'll just, it's confession time, okay? Okay, you say, I confess in the chat, in the question box if you're this. I don't know about you, when I go to get the milk, they kind of put some milk out front, but if you reach back in the little dairy section, if you reach back to where they hold the milk, and you go way to the back, you can find milk with latest sex. Oh, look at these people confessing to this. Look at the people confessing. Oh, yes, yes. Now, wait a minute. Think about this. The store owner is putting the milk that will expire soon out front because he wants to what? Sell it. He wants to sell it because its value really starts to decay with a week left or very few days left. But you and I, we're going to reach back. We're going to find something that expires later on because we know we can leave that in the fridge for a couple days and it really doesn't have any effect on it on this time. But these last 2 days, that might be smelling, might be a little bit, don't want to be chewing on your milk, guys. Don't want to be curding in that milk. Is that a good analogy? Yes? Does everybody understand that these options have time decay and they become worth less and less? Well, let's take a picture of all this stuff right here. So there's a time element in a time value, and you'll learn about this more and more as you go through 4 pillars. We won't go into great detail here because we're trying to learn fast, so we can't go into great detail. But let's get rid of all this ink here for a minute, Corey.
Yeah, Andy, and one note on that: if you said that premium was $3, what he's showing there is assuming let's say it's an out of the money option, which means that it is not close to the stock. Okay? If you look at its value decay, the small amount, you buy it with 3 months, so 90 days of life. From 90 days to 60 days, you just lost 1 month. The option won't lose 1/3 of its value. Some people think, well, that $3 option should then be worth 2 and then 1 and then 0. No, it doesn't go in that fashion. That $3 option might only have lost 20 cents of value in that first month. Maybe it goes to $2.80 or $2.70. it's a slower deterioration. It's a slower erosion.
Yep.
And then the next month it picks up a little bit more. And then the final month is when there's a lot of premium lost, a lot of time decay is what we're talking about there. So that $3 option goes to $2.80 and then to $1.90, and then there's $1.90, like half of its value is all lost in that final month. That's the erosion. So that erosion is what we're looking at there. How an option that is all based on time value, right? How it would erode over time as dates and times tick away.
So let's look at this right here. I'm just going to look at the short option that we've sold, and the only way to get out of this contract is to buy it back. So right now, if we were to buy this back, it wouldn't be too bad. We have $82. Oh, this is our GLD. Yeah, I've got this in the right deal here. If we want to buy this option back, and this is the only option we sold, of the $82 we collected, we could sell it back for less and pick up $29. With the long option that we bought, you can see these parabolic lines. You can see the purple line has today's date on it. And right here, if we wanted to buy it back or sell the option we have, well, we'd lose $9. And if you put them both together, we have a $19 profit if we want to get out today. Now, we have a total of $38, right? We sold one for 82 cents. We bought the other one for 44. The difference between that's 38. And we can get out right now today and make 19 of that 38 bucks. About half of it's in our pocket right now if we want to get out. But you'll notice something here. If I take this calendar, and please watch the timeline this time. This purple line is our time decay. It is that line that I showed you here. It is that time decay line. And watch the value of this drop as we get closer to our expiration date. It's very subtle, okay? But just watch this purple line as I just march the date along. Am I allowed to march that here? Maybe. Yep. Okay, here we go. Whoop. Nope, that's doing a whole month at a time. That's not going to work for us. Oh, I wish it would just let me march it. Let me try it this way, Corey. Just a second. Go to today. How about this? Oh, look at this. See it marching along? See that? Whoop, I'm going backwards. You can't go back in time, but you can go forwards. Okay, here we go. Let's get to the 26th, which is today, and just watch the purple line as I march time forward. Watch. Watch us make money. Watch the standard deviation close. See how the bar is getting closer and closer and closer to conforming to the expiration line. In fact, we still have here in the calendar 4/16. We got 4 more days to go, but we're at 100% profit in those options. We could pull it off the table right now. Finally, when we get clear down to the 18th, that's expiration. That's when this thing expires, right? The 17th of April. Now there's no time left. And we're up $38 if the stock's here. We're up $38 if the stock's here. We're up $38 if the stock's here. If it comes halfway, we start losing money down here. And down here's our max of 462. So this blue line is what the deal will be at expiration. And the purple line tells me how much time value is left. And since I sold the option, I got to buy back that time. You don't have to have this perfect because it's on paper, and we're going to have a lot more of these quick start labs before we're done. But how many are starting to catch the idea that all we're really doing here is watching time tick away for this option to be to expire, and now we keep our money for sure. We don't have to pay anything. There's no promise, and we get to keep that 38 bucks. Is this cool stuff? Oh, look at that. Mary says she's getting it. Oh, that's awesome. That's awesome.
And we had a question that I think is a very good one in terms of just kind of slowing everything down. So remember, this shaded area is your standard deviation.
Yes. Let's do that.
What the market's telling us is here's where it's probable that it's going to be. A 1 standard deviation is 68%. So notice as you march time on, if the stock is still at the same price, we're just assuming the stock is still at the same price, what's its probability of that it can wiggle, that it can move? Well, as you get closer and closer to expiration, the expected movement is smaller because there's just not enough time for it to get away, right? It would have to have some big event that was unexpected to get outside of it. So right now it's saying, hey, we could move in this big range. But as you get closer and closer to expiration, the volatility shrinks because now there's just fewer days for it to go away.
That's right.
If you say to me, well, how much can gold move over a month? I'll say it can move this much and have my hands wide. And then you say, well, how much could it move in 3 days? And I'd say, well, it can only move this much. And I put my hands really close together, right? That's how much it can move in a short time period. Here's how much it can move in a longer time period. So that's what this area is showing. Its probable range that it's going to be in from now to expiration. So you'll notice on that risk graph, back to our teeter-totter, our whole turquoise area, that turquoise line, it's all outside of that range. We put on a trade that from the very start was likely to succeed. It had a high probability of success. That's why it paid us less premium. It didn't pay us a huge chunk of money. It paid us $38 per spread, right? $38 per spread because we weren't taking a high high premium trade. We were taking a high probability trade.
High probability.
So we got less money up front, but it was always outside of that expected range.
That's right. Now we just did one contract here. See, +1, -1. We just did one contract for $38 and $4.62. Now, if you wanted to go $4.62 and add a zero to that, and you wanted to risk $4,000 instead of $462, how much money would you make? Let's see if someone can do the math on this. If we'd have done 10 contracts instead of one contract, and we would have risked $46.20, how much money would we have brought into our account? Does anyone know? That's right, $380. So you can do as many contracts as suits you, $380. Now, think about that for a moment. If you're in the rental business, I mean, I have a rental house that brings me in about $380 a month. But I'll tell you, my down payment was a lot more than $4,000, right? But even then, remember, we got $38 here, and we only have to have $462 in our account, $462. We're still making 8% on our money. And this expires on the 17th of April, less than a month. So, when you start to annualize these types of things, they start getting very, very, very exciting and insane. So here's what's really strange. Someone says, well, Andy, if these are real and these annualized returns are there, let's get that back down, divided by 12 to see what we're going to do this month. If I can get 8% on my money in a month, real estate, that's tough to do in real estate or other investments. Why doesn't everybody just do this? Why doesn't everybody? I mean, look at this. And I got an 89% chance. Well, let me just give you a warning. This is how more people blow up their account, perhaps, than any other way, is that if I make 38, let's just go 1, 2, 3, 4, 5. Watch this. 6, 7, 8, 9. Let's go 10 months. And I go $38, cha-ching, and I do it the next month. $38, cha-ching, and I do it the next month. $38, cha-ching. And I'm calling my neighbors now. I'm bragging at the golf club. I'm now this awesome investor. I mean, I'm awesome. I'm amazing. And for 9 months in a row, I've done this. So let's add that up. Let's see how much money we made just crushing the baseball here. I just killed that. Unbelievable. Can I get it back? No. Yeah, I can. Awesome. So watch this. Let's go $38 times 9 months in a row. I've made $342. That is so awesome. Let's put that in the bank, man. $342. Happy as I can be. But the percentages say that for every 9 times I get this, there's going to be one time, this is maybe why everybody doesn't do this. There's going to be one time where I lose how much? 462, because I have to keep the promises I make. So here's minus 462. So this is my total gains. This is my total losses. Let's see how this works out. $342 minus $462 equals, well, wait a minute. I just took 10 months of my life doing this, and I was so happy, but now I'm down. It took away everything I earned plus another 20. And if I do that over and over and over and over again, my bank account graph over time will look like that, won't it? This is a losing strategy over time. Let me say it again. This is a losing strategy over time. Who can appreciate that we're not just going to show you the rewards here, we're also going to spend this session on the risks. Do you follow that? And Pedro makes a point. He says, well, it'd be even worse if this month was number 5, but then I go back and maybe get some 38s too, right? So this is you're welcome, Kayla. I hope I'm getting that right. Yeah, this is education. So I'm going to say something, Corey, that unless this gaps down, someone said, why did you put this so far down here? Well, the chances of it gapping down this far are lower, but I want to make sure I have a couple things here. Number one is, do not position size to reward, position size to risk. In other words, if you have a car payment that is $300 and something, and you say, hey, I'm just going to add a zero on this and I'm going to make my car payment, right? I'm going to position size to reward where I can now make a car payment. I got $4,000 to risk and make my car payment. Well, guess what? All those numbers are going to play out. So, Corey, am I okay in saying that rule number one would be to keep your position size manageable, so if something nasty happened, you wouldn't be overly exposed? Is that fair to say?
100%.
Yeah.
100%.
Like
position size towards risk. You don't look at how much money I want to make, because once you start making that assessment, well, of course we all go to thousands, right? We're like, well, I want to make tens of thousands, but how much risk do you have to do that? You always position size for your risk, and the rewards will take care of themselves.
Okay, so rule number one is position size to risk. Let's just, excuse me, I apologize for my cough. Apologize. So let's get rid of this, and let's just say our first rule is position size. Is we don't want to get out of control with all of this in one stock or one position. So we'd rather have 4 or 5 positions that we can handle, okay? That's one. Okay, number two, what I'm going to say is avoid a max loss. Avoid a max loss. Let's just watch what would happen here. We have our math over here. Let's just see what would happen with our math. We'll make that small. If we did this, what if all of a sudden this thing really started to take a dive and it got all the way, say, to here, right to where our strike is? Well, how much does it cost us to get out of this trade? Don't you answer, Corey, let them answer. As you notice, right now we're up $20, but if it fell to 150, we'd be up 6. Here's our break even. Now if it goes to 145, we're down 22. Now if it goes here to 140, now if it goes to here, we're down 128, and so forth. Okay, so blah, 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 blah. So let's just put it right at the strike. Can anyone tell me how much it would cost us to just get out of this trade at this point? Like, just get out of this trade at this point. Who can tell me? What would our loss be if we just got out at this point? That's right, 126. Well, so wait a minute. If instead of taking, and I made all these big, so you have to excuse the extrapolation. So now, instead of losing 426, right, we'd have 3,000 here, and we'd only lose how much? We'd lose, 1,200, whatever it was. About 1,260.
1,260.
If we had 10 contracts, 1,260.
We had 10.
Okay, let's just get rid of all.
So in other
zeros.
words, we'd lose. Yeah, if you lose all those zeros, we're bringing in 38. If we take that loss, it's $126 loss for one contract.
Now I don't know if I'd do it.
That being the point.
Now I'm going to show you something really cool. I'm going to take this right to where the lines cross, and that's a $154 loss. But the reason that I would probably wait until it hit there is, just watch this. time, every day that goes by, time is on our side. And this is called theta. Okay, right now, as this time decays, this theta means we're making 91 cents a day. Every day this goes away, it's 91 cents. And of course, that is going to accelerate. Right now, we're early in the trade. It's 91 cents a day. But as we get into here, we'll get into over $1 a day that we're getting off this trade. So that's how that works. Now watch, I'm going to put this right here, and that's called the theta switch or the time switch. And just notice that as time ticks away, that if I am on this side of the theta switch, time going by helps me. But if I'm on this side of the theta switch, time is going to hurt me. Let's march that time forward and just watch that if I'm anywhere in this area, like we mentioned that 124 loss area, well, watch what happens to this as I march the calendar forward again. Here we go, and march. See where the theta switch is? See how if I'm on the right-hand side of the theta switch, I'm benefiting from time decay, and if I'm on the left-hand side of the theta switch, I'm being hurt by time decay. So I really think this area is important, that if you come here, you can just take this loss and avoid a max loss. That's one way you could do that. How many like this idea? And saying, hey, how many realize there's going to be times where you are going to have to take this, right? Marianne says, am I taking my... I am, actually. She says, we need you here, so take care of yourself. I've got more vitamins and stuff and going in here than I can stand. Now, there's also something else we can do that's really interesting. And this is called delta hedging. You don't need to know this perfectly because you're just learning. And if you really want to master this stuff, after you kind of get your feet wet in the Quick Start Labs, if you'd like to really hang out with Corey and I at the higher level, take the Ultimate Options class. I don't let people take it out of the gate. I like to see people with a little, ground under their feet and a little understanding before they get into that class. So that's still a little ways out for you guys. Just stick with this for now. But we go heavy and take this to whole new levels, as you can tell, as we get going. So that's cool. Let's show this, Corey. Right here, at where this price slice is, you'll notice right here we have a delta of 15? Is that right, Corey? Am I reading that right?
Delta of 15.
And this is a little skewed because the price isn't there yet. So it's a little skewed. But this is a delta of 15. Now, you'll notice here, the way I like to teach this is this. What if, and we have graphics that are more fun, but let's say that this is you. This is you right here, okay? This is you listening, watching, you're trading, and you put some money out here in the market, and all of a sudden, this trade gets really, really ugly, okay? And it's got teeth like this, okay? Like a big freaking Tyrannosaurus, okay? Something like that, big, like a Godzilla type of monster. He's really mean though, right? He got big teeth and he's got little tiny arms, like I don't know what they do with those arms. But, he's this big monster and a big nasty tail with an arrow on the... that's an ugly looking monster right there. Okay, how are you going to fight that monster? How are you going to fight that monster? There's just you versus the monster. Well, I'll tell you how I'd fight that monster. You know how I'd fight that monster? Lisa's laughing at my artwork here. Trey says, that's the best sketch you've done. Okay, well, watch this now. Watch this. You know what I would do to fight? I would never fight that monster. What I would do is I would go and I would get my friendly monster, right here, and I would get one who's just as big and just as mean, okay, just as angry. He doesn't look very mean or angry. He's got bigger eyeballs, though. And he's got maybe the same claws, same thing. And I would have him, he's got a big arrow on his tail. And I would say, and this guy's name is Fido. And I'd say, Fido, go get him. If I have investment A, watch this. If I have investment A and investment A turns nasty, Well, then I'm going to go out and buy myself a FIDO investment B. And now guess what? We have two trades that are evenly matched against that are evenly matched against each other. So watch this. That's what we're going to do. We're going to neutralize this. We're going to neutralize this trade. So if this is called delta hedging. So right here I have a 15 delta, and this is a bullish trade. We want it to go up. So what is a trade that I could get with a negative 15 delta, Corey? Do you have any ideas here? A negative 15 delta. Can you think of one?
Yeah. So you can obviously go to the stock, go to the source itself, and create an opposite position. Because in stock, we can go long or we can go short, and we can match up. We can match up a monster to fight that other monster. And people pointed out the tails. The tails were kind of interesting, where one monster's tail was going up.
Yes.
The other monster's tail was going down. There's information there, right?
I wish I could say I did that on purpose. That must have been in my
Well, it was a great slip because it made perfect sense to me.
Amandeep caught it. Okay, so do I want to go long or short? Let's get rid of this right here. Do I want to go long or short? Well, if I'm in a bull put spread, and this is a positive delta, what delta am I looking for? A positive 15 or a negative 15? What would fight a positive 15 monster? Type it in. A negative 15 monster. Does that sound right to you, Corey?
Yep, that's right.
Okay.
In other words, we have an existing bullish trade. A hedge means we need something to counterbalance that, so that as if this thing is going against us, and remember, we're talking about the asset is falling. We expected it to stay up. It's falling, so we need to add something negative or bearish to counterbalance our bullish trade. We're putting on a hedge in that case.
Now, how many shares am I shorting here? How many shares am I shorting? 15?
Yeah, so 15 shares, and you match up. So a delta, you can think of it in terms of a delta only goes to one. One is a full delta. And that means basically with stock, we have stock trade in a full delta. So every $1 the stock goes up, it makes $1. Every $1 the stock goes down, it loses $1, right? With options, they're partial deltas, meaning they're not trading at full deltas. There's a portion being made. And that delta in your spread gives you an idea of how much delta you need. So, kind of think of it as a percentage. If you're at a 40 delta, that's 40% of full. If you're at a 60 delta, that's 60% of full. If you're at a 15, which is what we were analyzing here, if this has a 15 delta, then it's 15% of full. Or in other words, I don't need 100 shares. I need 15 out of 100. I need 15 of the full 100.
Now sometimes it helps, to take all that math and put it in a picture. And so all I'm going to do here is show you something, and just watch this. This is what our stock trade looks like, okay? It has a slope. Watch this. It has a slope that looks like this. That's our stock trade. It's a short. So let's see if I can get that even a little bit better. In fact, I'll even color it in, we'll say, red. So its slope looks like that. If I look at the slope of our option trade, well, guess what? That slope looks about like this. And if you were to add those slopes together, one is a monster headed this way, and the other is a monster headed this way. And those of you that are engineers and know about vectors, you're getting all excited about this. You're like, oh my gosh, if I have this red one and this blue one and I fight them together, I'm going to get neutral. So watch this. Just watch the purple lines. Watch. Here I have one that is sloping downward to the left, and here I have one that is sloping downward to the right. And if I put those together, I get a flat line, where it looks like, look, that 143, 145. Do you see how my price is not moving at all? So now the stock can go up, the stock can go down, the stock can go in, but I'm really staying about 145, 144 because my delta now has fallen from 15 to 0.40. That's called delta hedging. Now, let's do it at the current price. Let's see where if we had to delta hedge this at the current price. So right now, our delta is really low. It's at 2.7. 2.7. So watch.
2 shares.
Yeah, and let's just say, and let's let these guys figure this out. So right here we got 2.8. You guys tell me, how many shares should we short to make our line go flat? How many shares should we short? Now, I can't short 1/8 of a share, so you got to round either up to 2 or down. Okay, so it's unanimous, 3 shares. Let's see what happens to this purple line if we short 3 shares. Let's see what happens here. Whoop. And short. Look at that. Our line went flat, and now we can lock in that profit. Now, notice we have a $20 profit. If I get nervous and I want to lock that in, I can, bam, hit that. And now my $20 profit is locked in a nice wide area here, pretty much because it's flat in this area right now. That's called delta hedging. So if you ever get your stock in a place where maybe it gets down here in an ugly spot, and you don't want to sell it, because it might come back up, right? It might come back up. You can lock in losing that half, and now if it goes down, what if you could just say, look, if it goes down, I'll lose the 155, but if it pops back up, I'll hit a stop, and it can expire my gain. So that's called delta hedging. You don't need to understand it all right here. We had a great question, why $3? Again, if I get to where I am today, I can see that my delta, in other words, the amount of money I gain or lose in the first dollar move of the stock, that my delta at this price slice right here is 2.8. Well, I can't short 2.8 shares, and 2.8 is closer to 3 than 2. So you guys say, let's short these 3 shares. Let's see what happens when I click this on. Let's watch the line go flat, oh. And so now I'm what we call delta neutral. I'm less than 1. I'm 0.2. which is about as flat as it gets. If you like this, type in, say, I like this. I'm learning cool stuff. Now, here's an interesting question. Yeah, this is called risk management. And, there's 4 pillars. Okay? Which pillar is the most important one? Which pillar? There's 4 pillars. You guys got it. That's why this entire Quick Start Lab is introducing you to the cool things we can do with risk management. Now, you guys might know that I wrote a book. I don't know if you know. I wrote a book called 401 Chaos. And I was very, very nervous, about 401 Chaos. Because I thought, boy, if I put that out there, I might get like 1-star reviews and people might think I'm crazy. And so I put it out on Amazon, and I got 5-star reviews, and I went and read them, and they said, boy, this is a great sleep aid. If you've got insomnia, read this book. You'll be out like a light, and it's not habit forming. So that's no, I'm kidding. But he says, man. So 401 Chaos, I really tear the 401k apart, because think about this for a minute. Do you realize that it's not just with this spread that we can use this delta hedging, that we can neutralize a portfolio like this, put an asset on it to where if it goes down, do you see how forgiving this is now on the purple line? It's way forgiving. The amount of money I lose up or down, I could just kind of hit the pause button here. And if it goes down here, I got $19. If it goes up here, I got 18. Pretty much the same amount. Instead of this, to where if it goes down, I'm losing lots more money. Now I'm down to $4, right? So the reason I don't like 401ks is they just let it fall. They just let the thing go down. And if a person knew their delta, and what's insane is you can do this with beta weighting. You can do the whole portfolio and neutralize the whole portfolio with some trades right here through this thing called beta weighting and delta hedging that I just think it's crazy that people throw their money in a 401k where with a little bit of knowledge of how you can neutralize things, put a little antacid on this. You don't have to sell if there's tax problems. You just want to get compensated for there's a million reasons to do this. And so this is a big deal, okay? Big deal. Now, this is really important. If I'm delta hedged, as this goes down, why is it that this works? Well, because as the option trades lose money, the stock trade gains money. It's two monsters. So someone says, well, how come I'm not losing? Well, you have two monsters. If one monster starts to lose, that means the other one's winning. But if the other one starts to win, that means the other one's losing. That's fine because now my portfolio looks like a teeter-totter. In other words, watch. The reason it works well, let's draw a picture of this so we're not confused. Let's draw a teeter-totter that can go 4 feet high here and it can go 4 feet high here, okay? 1, 2, 3, 4. 1, 2, 3, 4. Now watch this. Let's say that this monster is fighting on this side, monster A, and this monster over here is of equal weight, and it fights over here, monster B. So let's trade. Let's now make a new one, and let's say that this one is at 0, and this one is at 4. Now let's draw and say, look, we lose ground. This one's at 1, but this one goes to 3. Well, what's the total? 0 plus 4 is 4. 1 plus 3 is 4. Let's say it evens up, and this one continues to rise, and this one continues to fall. Now it's at 2 and 2, which equals 4. It doesn't change. Let's say that, let's get a different color in here, like brown. Let's say this one goes up to 3, and this one falls to 1. 3 plus 1 is 4. And let's say this one goes all the way up to 5. What color can I use? I don't have any colors left. Let's see. I got to get violet maybe. Let's say this one goes up to 4 and this one goes down to 0. You still have 4. So no matter how many feet this one gains or loses and how many feet this one gains or loses, you're always going to have a net result of 4. It doesn't matter. And so no, you're not losing anything right here. You're not losing anything as the stock goes at all because you're delta hedged. Now, if it gets down here and it starts to get a slope again, well, then recruit a bigger monster again, right? Okay, how many like the general? Now, I don't care if you guys understand this completely right now because it's your second time. The only thing I care about, I don't care about the math and stuff. The only thing I care about is that you basically understand that by getting one trade that's going one way, if you create an opposing trade, they neutralize each other. So how many understand? I understand the big picture of neutralization. Fantastic. I'm so glad you're here because, we got to learn this so fast and so quickly, and it's so valuable. I'm just curious. Had you come and we'd have met maybe a year ago, and some of you have been with us longer than a year, and you're just repeating, which is great. But how many think if we'd have met a year ago, that this education would have been worth a lot more because you could have had it going in. Yeah, someone says, I need to watch this again. And that's okay, right? I looked at the magic in the beginning. Now the fog is going away, right? So that's the idea.
There was a good question there that said, well, if you always neutralize everything, how do you ever make cash flow? We're giving an example of neutralizing, but remember, this is a risk management strategy. So we don't put on a trade and then immediately get delta neutral because that would be counterproductive. Yeah. It's more a lever that we can pull that if GLD in this first example, remember we're way down here. We have high probability.
Yeah, we don't need to delta hedge right now.
Yeah,
we really
what
don't.
If it traveled that way and we started to get in danger? Now all of a sudden neutralizing the trade sounds a whole lot better because of the risks involved, because now we're in a position that maybe we're not even, at that point, we're just trying to minimize the damage, right? If we bring in the $38 over and over again, we know that there are going to be times where we need to manage risk and get out of the trade, not at a profit and not even at a break even. We need to get out at a loss, but at as little loss as possible. And so that's the approach that we're looking at.
This is exciting.
Is
Watch
neutralizing
this.
When needed.
Yeah, watch this. I'm going to just ask a yes or no question. Right now, we're up here. We're on this side of the curve, and right where the stock is now, we've got an 89% chance of just taking our money and run. Now, let's remember what that means. That means that we got $38 in divided by the 462 in our account to manage the risk. That means right now we're making 8% in a month on our bank account. So let's see who's okay with that. Who's okay with 8% a month on that 462? You okay with that? Yes? Everyone's good with that? Okay. We got an 89.89% chance that that's just going to continue. So I'm going to ask yes or no. Would we want to delta hedge this trade right now and neutralize it, or just enjoy letting this time decay towards our $38? Right now we're up 19. Should we panic and sell? Should we be smart and delta hedge, or should we just leave it be right here? What do you say? That's your choices. What do you think? No panic. We're going to leave it. Yeah, we're in good shape. There's no reason to freak out right here. Let's leave it. Let's enjoy. Everyone breathe. Let's enjoy, okay? Hey, we're going to have coronavirus happen and all this stuff's going to happen, but you know what? We're making 8% for the month on this money. Okay, beautiful. Now, let's say it moved right here and oh my gosh, you're down $17 now. Should we panic, or should we say, well, yeah, right now if I got out it'd cost me $20, but on the 18th I'll have the time decay. Watch. That time decay, all I got to do is sit and wait. Whoop, I'm going the wrong way. Can't go back in time. All I got to do is sit and wait and watch. Watch my break-even point chase me as time goes. Watch. See that little tick right here, break-even point? See how time is on my side if I'm in this area. See, time is still on my side if I'm in this area. So let me ask again. If it got, right here, should we panic, or should we let time work for us at this point too? What do you think? Panic or let time work? Yeah, we're going to keep waiting. Oh my gosh, we were wrong about gold. Wow, we wake up in the morning. Wham! We're clear down here at 222. Wham, we just got killed, 222. Should we, now this is where people get killed. Should we hope that it goes back up before the 18th? Should we hope? Oh, look, we still got a lot of time to April. Maybe it'll go back up. Should we hope, or should we take action and delta hedge? What do you think? Take action. Now, where will we neutralize our loss at? How much money will we be neutralizing a loss at? 213. That gives it a chance to go back up, and then maybe we take the delta hedge off and enjoy this in the warm weather. But if not, we might think to exit that trade. If it gets right here, we might delta hedge. So it's only when it gets in what I call this little nasty, I have a name for this, don't I, Corey? I think I invented this. This little area right here, okay, is the worst place, and it's actually a parallelogram, but I kind of go like that. I call this the Bermuda Triangle. This is where it's nasty, and this is where it's ugly and nasty. So this is where I start delta hedging or taking half off the table, and we've got many, many, many different strategies, but our goal for today is not make you an expert in delta hedging today. The goal here is simple. To understand that right here we can relax and enjoy. If it goes up here, what would I do? If all of a sudden gold went way up here, what would I do? I'd get out of this trade and take my $36 and go do another one, because I don't want to wait till 418 for this to expire. It's went up. I can already get $35 out of it. Let's take it and start a new one somewhere else. Right here, let's sit and relax. Right here, let's sit and relax. Around this area, I probably start delta hedging, maybe get out of the trade, maybe take half my contracts off the table. You're going to learn in the Ultimate Options class how to roll up and roll out and, all kinds of cool stuff. But again, relax here a little bit. The idea here that's more important than anything else, is to understand that I have things I can do to avoid this max loss down here. That's not what we want. We don't want to have one of these max losses down here that takes us out so bad, okay? Does that make sense to everyone? Yes? Okay, fantastic. Okay, wonderful. Okay, now we've got a couple of questions. Gary's asking about creating a paper trade account. If you guys have not set this up, we have something called the Beginner Investor Bootcamp. So you can, and you don't have to use this software if you don't want to. You can use any charting software that you want. This is Thinkorswim. If you're outside the United States, you'll probably use Interactive Brokers. And charts are a lot like a car. No matter what car you get, it's going to have four wheels, a steering wheel. I could buy my wife a Mercedes. I guarantee you she could drive it day one. I might buy her maybe I don't know, what does she like? She likes kind of SUVs. She drives a Tahoe right now, so she loves that. But she could drive either one because they're not the same car, but they have the same parts. So if you have not gotten into this stuff, this is called Thinkorswim. Corey and I did something called the Beginner Investor Bootcamp. It's in the website. Just poke around. It's kind of by your 4 pillars modules, and that'll show you how to do this, how to find software, run searches, the whole bit. So fantastic stuff. Okay. Now Tyler Betts has a good question. How can I make my money early? Well, notice right now, if I bought this trade, I can get out by closing the order and selling it. And if I sold this, I can get out of the order by buying it. See that? Right here, if I bought this option, I can close the order by selling the option. Right here, if I've sold this option, I can get out of the order by buying it. That means if I look here, I want to get out of this right now, I can leave, and we made $18 in 2 days. Half the money available in this trade we could put in our pocket and leave. If the stock goes higher, right, now I can get $30, and if the stock goes up here, I've almost got it all. So if the stock went up here, all I would do is say, boop, close the trade, take my money. Boop, close the trade, take my money. And it'd just be that simple. So we could get out anytime we want. Someone said Investor Bootcamp was great. Thank you, Michael Wheeler. Beginner Bootcamp is in the Mentor Club. Thank you, Billy. I didn't know where it was. It's in the Mentor Clubs, probably in both. Okay, fantastic. And Ian makes a great point, is my son doesn't drive. He's 14. He doesn't drive as well as I do because he hasn't been in a car very long. And I'll just say this. You guys probably are all younger than me, so I'll talk to the old birds like me first. How many of you are old enough to remember when email was invented? Say aye. I remember. The first time you used a computer and a mouse and an email and all that, remember how, you had to figure out how to do the attachment. Oh, what does the carbon copy button, forward, carbon copy all. They still put that too close to the CC. And then you got the send, and then you got the attachment. How do you open the attachment? And it was called Techno Fright, right? I remember when I used to be on the internet, it sounded like, and made all these noises, and, you had trumpet windsock, whatever that was. And, it's just insane. AOL, you have mail. Well, how in the hell do I get to all that? Yeah. Patricia got it right there. You've got mail. She was right on it, right? Yeah. Don't make me laugh. It makes me cough like crazy, okay? And so this is kind of the same thing, and I really appreciate that comment that says, Andy, right now I think the toughest thing is learning to pilot all this. I mean, you're just poking around these buttons. Well, I've done this a couple times, You'll probably start with going chart and analyze, right? Chart and analyze. And then you'll start learning how this stuff works. And this is why I encourage people to begin by practicing in what type of an account? A simulated account. Because guess how much money you can lose in a simulated account? None. Guess how much money you can make? None. So if you make a bunch of money virtually, you can go buy a virtual Ferrari and go on a virtual vacation, but you won't lose money either. Can you appreciate this? Yes? Yeah, I got a lot of people saying this and that and the other, okay? Now, Ian, check with Ameritrade, and Ian, if they don't let you use Thinkorswim, maybe check out Interactive Brokers, okay? That's a cool thing. Okay, Corey, what else you got for us? Anything else on this trade?
Pretty awesome stuff. We had one other question about what happens at expiration, and at expiration, it's really simple. if the trade is where up here above our strike prices, it just goes away. It expires worthless over the weekend. There's no requirement to close the trade or anything like that. So anywhere 136 and above, that's our strike price.
Right here.
Any price above that, this trade would go away, and we would make our max gain. So
we already have, and Corey, this is important to understand. We already have the $38, correct? We already have it.
Right.
The only reason this is here is if we want to get out, we have to sell back the promises we bought and buy back the promises we sold to get out. So we already have the $38. And once we go to expiration, let's just go forward, and there's no time decay line anymore. Ding, there you are. You keep your $38. See? You've kept your 38, and all this stuff disappears and goes away, and your $38 was there at the beginning. So it's very simple when it expires. Keep going. Sorry, Corey. I just wanted to interrupt there a little bit.
That was great. And that money comes into your account. It's a cash contribution, so you'll get that $38 of inflow into your account after you sell this trade. And when you think about buying the trade back, it's, this trade is always changing in value. So when we put it on this spread trade, see, if you look at the strike prices, here's a good way to think about it. The difference between the strike prices we already talked about was your risk, or the most it can go to in value, which is $5.
Let's help them remember this. Is remember from last session, we had Corey and someone else, Joe, and Joe paid Corey, watch this, Joe paid Corey 82 cents in this case. It's gotten a little better since last time. We actually got 82 cents here. And he did this because Corey made a promise, right? A promise to buy at what price, Corey?
At 136.
136. Now, Corey then took that $82 that he had, and he spent it. He spent 44 of it. To let's say Joe and let's just call this guy Melvin. And this time Corey wanted the choice to sell,
to be able to get out of
131.
If I have to buy at 136, well, my exit, I know that I can get out of it at 131. So my risk in a spread trade, and here's the simple point. In a spread trade, you can always take the difference between the strike prices in these vertical spreads, and that's the most that spread can ever be worth. So if you have a 136 and a 131, the most this thing could ever trade to is $5. And what's the minimum? Well, it could expire worthless or zero. So you're always in this range where this trade is somewhere between $0 and $5. When we put it on, we collected 38 cents. So that's a small portion of the $5, right?
And
that's
this is
small
important.
Reward.
This is
bigger
important.
Risk for the high probability.
Yeah, this is important. If Corey has he has to buy at 136. That's his promise. But now he can sell at 131. That's his option. So his loss would be $5. But he already brought in how much, Corey? 38 cents. 82,
38.
44. So 5 minus 38 is $4 and what, somebody? Someone tell me. $4 and $4 and 62 cents. So my total risk in this trade is, drum roll please. Whoop, if I can get there. It's what? $462 because there's 100 shares in the contract. So that's how that worked. Corey received 82 by promising to buy at 136. Then he spent 44 so he could have the choice to sell at 131. If that happens down there, he'll lose $5 less the 38 cents he kept from those two trades. That's why it's not a $500 risk. That's why it's $462, because he's already got $38 in his pocket. Okay. One more thing I want to say about this. Someone said, "What is the best platform to use?" That's like kind of asking me what's the best car to buy. It's kind of a personal preference. Like some people would say a Ferrari would be the best car to drive. I would never own a Ferrari because I can't even close the door. I'm 6'8". I can't even get into that thing. So for me, like a great big F-250 is the best one for me. Let me ask you this, guys. What do you think? Do you guys think if Corey had to use a different platform, he'd still be equally successful? Or if he had to use a different brokerage, he'd be equally successful? In fact, let me see if I can answer a whole bunch of questions about technology and platform right here. Do you think it's the platform and software that makes us good at this, or do you think it's the education and practice that makes us good at this? I mean, if you think 5 years down the road and you look back, will you say, yep, it was the Ameritrade software that made me successful? Or do you think you look back and say, Corey Halliday is the man, right? You guys are so good.
Funny. It's funny because my son and I had a discussion on this. My son is 10 years old, and we were playing golf. And he said, Dad, if you had the same clubs as those pros, would you be as good as them? And of course, my answer was yes.
Yes, honey. Did Jackie overhear that? Was she there?
That's the only thing that's holding me back.
Son. I will spend any amount of money to help my short game. Give me that new putter, will you? Give me that new putter. What'll straighten out? I'll spend any money you can take from me to straighten out my slice. But it's probably not that. So just relax on the software. You got time to learn this. Look, I know you guys, it's a quick start lab. We're going quick, right? I mean, we're getting into stuff that, how many get the idea? This stuff usually takes a little longer than this to learn, but because Corey's such a man, we can accelerate this. So there's going to be questions, but I think if you take the analogies we give you, like the two monsters fighting and the teeter-totters and stuff like that, you'll say, you know what? I might not understand all these crazy numbers in here, but I think I'm starting to get a handle on what's going on here. So we're going to stick with this trade, and we got an 80% chance. The best thing that could happen is for this to gap down here and have to have us actually delta hedge it, but it's not there yet. And so until it gets here, we can't really show it properly because it's not there yet. That's why the Mentor Club's so awesome, because when you're in Mentor Club every week, it'll finally eventually happen, and you'll see me get all excited. I was like, finally, we got some losses to hedge. Let's really show how this is done. Because right here, to tell you the truth, I'm going to make my prediction, having done this a few times. With this stock sitting right here with, what do we got, less than a month to go, actually, I think this is going to wind up being a pretty boring trade, because you know what I think it's going to look like? I think it's going to look like this. Oh, let's go do another one. And that's what it's going to be like. Chances are, I'd say there's an I'll tell you what the chances are. I'd say there's about an 89% chance that we just watch this time decay and take this money. That's probably it. There's only a 10% chance this will get exciting. So I'm rooting for the 10. So you're saying there's a chance. Yeah, I am. So hopefully it does go down here. And if it does, great. We got the 10% chance to learn it. But in reality, I'd say 89% chance we're just going to take this money and do another trade. Did you guys have fun today? Yes? Ken says, I'll take those boring trades. I'll take them. I'm just glad that I have Corey, because most guys that are really good at this were born without a personality. So great job by you, Corey. This is a lot of fun. It's really, 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 really important. Yeah, you know what? Like I said, Vincent, some of you guys are really concerned about the software. I'm going to tell you, you're right. An important part of this is about software. It's kind of like this, Vincent. If you're going to send emails to people and you're going to email back and forth, definitely got to learn how to turn on the computer. Definitely got to know how to click the button to get the email program open. Definitely got to know what a subject line and a carbon copy is, an attachment. Yeah, absolutely, that's an important part. But your English class will what help you make good emails, and your debate class will help you with good rhetoric. So I agree. It's an important part, but that's a part that's learnable, is the software. And I know there's a lot of stuff in here. It looks fancy. But so far, we got the chart tool and we got the analyze tool. And the best way to navigate unknown territories to venture out. I moved to a different state one time, and my first day there, I didn't really know my way around much. And so what I do is I just got in the car and started driving because there was no harm in driving, and I always had a map to get back to home base. So just know that you can click on this stuff, try to figure it out. You'll click on this stuff, whatever you want. Because it's a simulated account, you can't make any mistakes. And the best way to learn is by clicking and watching Mentor Club. Oh, where did Andy click? Oh, he went to chart. Oh, over here he went to analyze. Oh, over here he added a trade. Oh, over here is risk profile. Because really, there's only been 3 buttons we've messed with: charts, analyzing trades, our risk profile, and adding new ones. This is called an option chain. And so those are the 3 you learn to navigate: charts, analyze, risk profile, getting the option chain. That's it for now. So with that, great session. Really good one. Next week, when we do our next session, we're going to do another cash flow trade that's different, a little bit different than this one. We'll have a different looking risk graph. But right now, our hope is you're understanding that, okay, this is what I hope you're at. I can make cash flow with smaller amounts of money, nice potential reward. I understand that there's a probability of success and a probability of failure. I understand that if I start to see there might be a probability of failure, there are things I can do to hedge. That's it. If you have those big picture concepts, you'll be catching and having more epiphanies over the next 3 weeks when we do our other sessions. Here's my most important question, and I ask this a lot because I need validation so I sleep well at night, and I know I'm doing some good in the world. How many are glad you signed up so far? Are you getting value for your education dollar? If so, say, yes, I am, and that will make me feel good if we get a few of those. Oh, it's not just a yes, I am. It's a hell yes, definitely, happy, thank you. Oh, my gosh, look at that. Most definitely. Hey, last time I mentioned, if you feel this would help someone else during this time, there's people out there that I can't reach. We advertise and we tell people, but I'll tell you, word of mouth is really the best for us. So if you feel I've done you a favor, do someone else a favor and tell us about it. You guys have already done a lot of that, so we thank you for that. Helps keep this going and keep the Cash Flow Academy is about the students. Corey can go trade, but you guys are actually helping people by being here. So it's just fantastic. Ian McFarland says, you know what? I think I'm starting to relax a little bit with this. This is going to be great. Vera says, incredibly live with you. Thank you. Corey, you got anything? We got filled on something. That's cool. Corey, anything you want to say before we go?
No, I think that's it. Awesome job, everyone. So much fun. I'm loving these, and always a great time with you, Andy. Great job.
Okay, fantastic. Thank you again, everyone. Thank you for all your comments. And when is the next Quick Start Lab? Let's see. Let's bring up a calendar.
That's a good question.
Let me,
the 30th, Monday.
Let me bring.
Right?
Do you have it here? Let me bring up my calculator. I have Monday.
Somebody saying Monday, saying Tuesday, and somebody saying Thursday. So I think it's Monday, though.
We have one Monday at 1 p.m. Mountain Time, and then we have one on Thursday at 5 p.m. Mountain Time. Our next 2 for the next week. In the interim,
so Monday, 3 o'clock Eastern time.
Yep, Eastern time, noon Pacific. And then we've got Thursday, which would be what, 7 o'clock Eastern and 4 Pacific?
7 o'clock p.m. Eastern. There you go.
5 Mountain and 6 Central. So your homework is get through 4 pillars, keep going. Someone said draw us another monster next time. Oh, I might draw a fish or something. One thing I do know how to draw, I know how to draw a fish. That I can draw. And and I'll get this cough under control, and we're just going to keep doing trades. Homework is Mentor Club. Homework is reviewed last Quick Start Lab. It should be posted today. Last session should be posted today in the Quick Start Lab section, so you can review that. And just keep watching videos, practicing on paper, having fun. And if you have a question, send us an email. So with that, that's in the can, man. Quick Start Lab number 2 in the history books. We'll see everyone next time. Thanks, and be safe, everybody. Be